Right. Well, time to start. Welcome, everyone. I'm delighted to be here. Welcome to our very first private banking summit. It's fantastic to see so many of you tuning in from all around the world, from SF to India, and most of you actually scattered all across Europe. So my name is Sebastian Tupi. I'm Chief Community Officer at Uniborn. And for many of you who might not have heard of us yet, we're a community-led platform that helps private investors to find lucrative investment opportunities. So generally, these deals would be led by investors such as angel syndicates or VC firms like Altair Capital, which has backed 7 unicorns at seed stage with notable investments like Miro, Deal, or PandaDoc that some of you might be familiar with. So what does that mean for all of you present today? Basically, we are here to help you and mostly help your clients to find great investment opportunities and then to facilitate the investment process to make your life and your client's life a breeze. So now that you know a little bit more about us, I want to talk to you about the agenda that we have today. I feel very lucky that we have 4 wonderful speakers that will be sharing some of their knowledge on some key points with us today, starting with Ihar Mahaniok, who's going to talk to us a little bit about the state of investment market in 2023. Thank you for being with us, Ihar. And then we'll also have Nick Davidov, who's going to talk to us about AI, probably one of the biggest buzzwords of 2023. And then we will have Marko, who's going to share a little bit about secondary markets and the work that he's doing in that space. Glad to have you with us, Marko. And then last but not least, we will have Max Pog, who's going to talk to us about the rise of venture studios and some of the sessions that he's run pretty successfully over the last few months. So without further ado, I would like to dig into the topic. And for all of you tuning in here, you can use the chat to post your questions. So we'll have about 15 minutes for each of the presentations. And during those 15 minutes, feel free to use the chat. And then after that, I'll make sure that each of the speakers can take a quick look. I'll flag the questions via DM to them so that they can answer them at the end. And at the end of all the presentations, we can have a little bit more of a Q&A as well. But make sure that if you have questions, you post them there, and then we'll address them as we go. But I will leave the floor for each of our speakers for kind of their 15 minutes to shine, and then we'll take the Q&A from there. So Ihar, please, the floor is yours. Feel free to share your screen and put your presentation up. And I'm really looking forward to what you have to share with us.
Thank you, Sebastian. I'm really glad to be here. Let me open the presentation. So it's a short 10-minute, we'll run through it quickly. We'll have time for questions in the end. So we are discussing the state of the private markets, right? So a little bit about me. I have more than 12 years of invested in more than 200 startups. 5 went all the way from seed to unicorn, 14 exits. Geek Ventures that I founded is a $23 million firm. We have 37 portfolio startups and 52% raised at higher valuation. We are very active. In 2023, we made 30 deals already, even though you all know that it's a tough market. Let's dive into what exactly is 2023 from venture perspective. It is a very investor-friendly market. This is why we are active in this market. So it's opposite to 2021. When it was much more founder-friendly market. It is, they say the markets are either easy to raise, hard to invest, or they are hard to raise and easy to invest. And 2023 is definitely hard to raise, easy to invest market. And a lot of founders and VCs find it's much harder to get investments of the size you did before, but it's much easier to find great investment targets at the right valuation than before, and I do expect that it will continue the same in 2024. There are way fewer priced rounds. We see that a lot of companies continue raising on safes or other non-priced bridge documents in order to either raise their pre-seed or seed or extend their runway. We see that significantly fewer price rounds of $2, $3, $4, $5 million than before. The round sizes are smaller, so of course, so companies that would previously raise 5 million rounds now raise 2, 3 million rounds. And valuations are down. So happy to dig deeper here. Obviously, you all saw the multiples on public market change significantly. The multiples like 100x to sales are now more like 10x, 15x, or sometimes 5x, 3x on sales on public markets. And on early stage venture markets, we see that valuations are normalized somewhere with multiples between 10x to 20x to annual revenues on seed, and probably and similarly at on Series A, sometimes even down to 6x, 8x annual sales. We see that pre-seed valuations went down as well. So we see much fewer rounds with 15 million pre-seed valuation, 10 million pre-seed valuation. 5 and 7 million US dollars became a new standard this year, and we expect it will continue for a while. There is way more time for due diligence. So it was a very interesting. Just yesterday, I was speaking to VC in New York who said that he stopped investing in 2021 because every single meeting with startup, you were expected to make a decision on the meeting. Like 15 minutes in the call, you had to make a decision whether investing or not. Now we see that we can take a month for deeper due diligence, and the quality of investment decisions 2023 went up dramatically because the investors can talk to customers, can talk to all the team members, can analyze the market, can look into competitors, have time for that. So there is definitely more time for due diligence, and we continue this to be a new norm for 2024. The late market pretty much went almost nowhere. We see the drop by 90% of 100 million rounds. So you see that 1,300 million rounds in Q3 this year compared to 130 in Q3 2021. And it's still lower than it was in 2019. I expect that 2024, 2025 might return to the norm of 2019. We do not expect to return to exuberance of 2021. So the larger rounds are gone, and mostly gone, and mainly it's connected to the fact that the VCs cannot raise the large funds anymore. We see that a lot of US startups are getting stuck at seed, and we see the same in other geographies, of course. So graduation rate from seed to Series A went down from 27%, which was norm, down to 17%. And this specifically talks about startups that raised seed in 2021, which to me is a signal that 2021, way more startups raised price seed than they should have. The startups that raised seed in 2023 will return to a normal 27% graduation rate to Series A. So we see the emergence of second seed. This is the concept that didn't exist before. What we see is that between a seed, which typically raised at 10, 15 million valuation, and Series A, which typically raises at 40, 50 million valuation, in 2023, a lot of companies raised second seed. Companies in our portfolio did that, companies in our community did that, which basically the company didn't have 3 million ARR yet. It has metrics that would have qualified them for Series A in 2021, like 1 million ARR. But they don't qualify for Series A this year anymore. So they end up raising second seed of about 3 to 4, 5 million in valuation, 15 to 30 million. And these companies would go on to try to raise Series A in 2024, 2025 at valuations of 50 to 60 million. What are the main themes I see in 2023? AI is key, both offensively and defensively. What I mean is that companies that sell AI or build AI first products are very much sought by VCs, and VCs are looking for them. And a lot of companies that are AI first are able to get higher interest. Defensively, I mean that all smart VCs are asking the companies, what are you doing about AI danger from competition perspective? Because the biggest danger that somebody can build a competitor to a startup on top of ChatGPT and or on top of other AI tools. So so we see that ChatGPT and similar AI tools will kill a lot of startups starting in 2021, 2022. Startups that start in 2023 only get funding if they have defensive strategy and they understand how to develop something so unique that you cannot replace with AI. Small teams and high revenue per employee are much more expected now. 2021 was and 2022 was a time when you had tens of millions of dollars and you could hire a lot of employees. 2023, you're expected to hire much smaller teams and increase revenue per employee and increase the productivity of your team thanks to AI. Runway is king. Situation of sending a 100K check on FOMO in a company that tells you that tomorrow the valuation will go up is not working anymore. VCs and angels are ensuring that the company that they're investing in has runway. The normal runway after pre-seed it is about 12-15 months. A runway after seed should be 18-24 months. And if the company doesn't have enough runway, they do not survive. And the companies with less than 6 months of runway that approaching VCs have really tough time raising because they're in a very weak position. Down rounds are brutal, so they happen in 2023. The most brutal down round I've heard is a company that raised $100 million, actually raised that much, spent this money, and went out on the market and raised another down round at 15 million pre-money valuation. Basically, almost completely eliminated all previous investors. And I'll talk a little bit about VC market, which from the perspective of raising for venture capital firms. The 2023 ended up being one of the smallest years by number of new VC firms, because what we see is that raising in 2022 and 2023 became much harder. So there are fewer VC firms, and more importantly, who are able to start a VC firm? Only managers with track records. So managers that have managed to actually return capital to in their previous firms or as angels. Managers that were really able to spot great companies, not just celebrities, and often not just founders. What we see is the disappearance of tourist VCs. 2021 showed that a lot of people with great networks but no track record were able to raise funds. 2023 doesn't happen anymore. Funds are significantly smaller. We see again and again that firms that set out to raise $1 billion funds end up raising half a billion. Firms that wanted to raise 100 million raise 50 million. And it always, of course, downstream effect that rounds that companies are raising are smaller. And LPs have their pick. So what we see that fewer LPs deploy smaller checks. But as Warren Buffett said, invest when others are fearful, and be careful when others are greedy. This year, others are fearful. So savvy LPs deploy, and the funds that closed this year or are raising right now and are deploying the funds this year and next year will have a very good chance to have high outcomes, because the valuations are down, because the market is investor friendly, and because there is a much higher quality of VC decisions. Okay, that was it. Happy to switch to Q&A. Sebastian, we get some questions?
Fantastic. Thank you so much for that overview. Very, very thorough. I don't see any questions yet in the chat, but if anyone has any, now is the time to ask. Feel free to put it there and then I'll check. I actually do have a question for you straight away. So a bit of a gloomy outlook, I would say, on the general state of the market over the last 18 months. But as you've mentioned, still quite a lot of opportunities for savvy investors and for people who understand the dynamics, right? So what would you say are some of the biggest opportunities that lie ahead, and how do you approach kind of the next 12 months, considering what's been happening and the state of the valuations over the last 18 months?
So as we were talking about more like of the past, about the future, I think that this is really the best market for investors, right? So it's hard to raise money, but it's the best for investing, deploying capital. As I said, we have deployed in 30 deals this year. We expect a similar number of deals next year, because especially at pre-seed and seed, there is the highest possible upside right now, right? We are We just recently invested in a company at 14 million valuation. We are now in the late stage of investing in a company at 5, and we are seeing great teams, amazing teams, able to raise rounds at much smaller valuation than before, and we expect the multiple expansion in a couple of years. So from that perspective, it's important. Another thing is that AI right now is much more interesting, a great time to invest in anything related to AI compared to, let's say, a year ago. You remember December 2022 when ChatGPT launched, and it killed literally a lot of startups that were AI adjacent, like Jasper and so on. And a lot of startups had to pivot to basically not be steamrolled by ChatGPT. What we see now is that investing in startups now, you see the founders are much more savvy about how to use AI for their productivity, how to use AI to improve the quality of their product, but also how to develop something special in their product that could not be just replaced by your competitor with AI. So I think, yeah, we keep investing in teams, brilliant teams that know and understand their customers' pain points, and they solve the real pain points of the customers across different sectors. And we see that there are so many sectors where there is still a lot of pain points. And let's say healthcare, property, real estate, product development, software development, and so on. So there are so many sectors where pain points are still not solved and cannot be just simply solved by AI. And what I also see that there is still a lot of room for unicorns. What's important is that the world becomes more globalized. It's much more possible to build a startup in one country and have billions of users in the world, or like hundreds of millions of companies in the world use your startup's product, because the world's much more connected, much more globalized. So that's where the new unicorns will come from.
Fantastic. Thank you for that answer and for the little segue on the AI side. We'll talk about that with Nick in a minute. So I just wanted that last question for you. Like, you're talking about the toughness in the market on the founder side, but obviously on the investor side as well, raising funds, which you've like talked about. If I'm not mistaken, you guys recently raised 23 million and had a pretty successful oversubscription on the fund. Like, what would you say are still some of the attributes that LPs are looking for in like fund managers that are raising in these difficult conditions, or what made you stand out compared to some others that might be struggling?
So what's most important, as I said, is the track record. Specifically, like if you have, when you're raising a fund, if you have any IRR, exits, DPI, TVPI numbers, that helps tremendously over those that don't have the. So I personally had significant DPI, TVPI, and IRR numbers when I was raising Geek Ventures. Then very clear strategy that differentiates you, right? So we had a strategy of investing in immigrant founders that are hardworking founders that really have nothing to lose on one hand. On the other hand, the statistics show that immigrant founders have higher chance of getting to unicorn status, and then we can help them, right? So that's where value add comes in, very clear value add. And also showing the progress, right? So we were deploying capital and raising at the same time, and every time we spoke to LPs, we had something new to show. We had deployed almost 1 to 2 companies a month, and all of these companies looked really exciting and interesting and great, and our LPs were really happy to jump on the moving train with us.
Okay, brilliant. Thank you so much. Very clear. If people have more questions for Ihar later on, or for any of our speakers, you can see up here, I have this QR code next to my screen. So you can just pin my video and then scan the QR code. Any questions for all of the speakers throughout this session, you can just fill in the type form. We'll make sure to connect you. If there's things that you want to know, people you want to be connected to, just scan the QR code over there. I'll remind you later, and then you can get in touch with everyone.
Yeah, I'd love to talk with you guys. Thank you, Sebastian.
My pleasure. Thank you so much for this presentation. All right, now I would like to move on to Nick, who has joined us. I think Ihar has talked about AI a couple of times already in this little overview of the market. A big buzzword of the past, let's say, 12 months at least. Nick, welcome.
Hi,
Um,
thank you so much for having me. My name is Nick. I run DVC together with my wife and partner, Marina. It is a collective of 119 investors. We are engineers, machine learning researchers, founders, including 6 unicorn founders, and a lot of angels who pool our capital into an evergreen fund, or a rolling fund on Angel List. We invest about 2.5 mil per quarter. We've been doing this for the last 2 years from this firm, and then before that, we were running another fund, and before that, another fund. So pretty much been doing this for 15 years, and we've been investing in AI since 2015, since we wanted a niche that we can claim to be good at before it becomes overwhelmingly big. But first of all, I wanted to start with saying that we no longer invest in AI companies, since we don't say that we no longer invest in companies with websites, or companies that use electricity. We now have to redefine our thesis so people actually understand what do we do. And we back repeat founders on earliest of stages. A lot of them are immigrant founders, so there we have a large overlap with what Ihar is doing. But we focus on repeat founders, and we focus on founders developing AI-based tools for businesses. We're still quite very early, so do you guys mind if I share a few slides real quick?
Absolutely, go ahead.
Perfect. So yeah, can you see my screen now?
Yeah, it works.
It works. Perfect. Cool. So if you remember in Lewis Carroll's Alice in Wonderland, she was attending a tea party, and the Mad Hatter said, my dear, here we must run as fast as we can just to stay in place. And if you wish to go anywhere, you must run twice as fast as that. This basically is where we are in today's world. Everybody's running twice as fast, just to make very small progress, because the speed of innovation is incredible. We first of all, our fund is like what I said, 30 mil under management, raising the 60 mil fund, blah blah blah. I'll skip all of our cool things. Basically, what I wanted to say is we are at the electricity moment of our lifetime. It's not been, it's not like super new. It's not today's year. It's not like all of a sudden this big hype. It's been in the making for a long time. We've been investing in companies that were trying to make this possible, but we're pretty much at the same huge pivotal moment where a lot of awesome companies can be founded and a lot of unicorns can be made. So first of all, AI is not new. Since the 40s, my dad was one of the people who was basically doing AI on a blackboard with a piece of chalk, like counting perceptron and stuff. And he's still making fun of me that we're like doing AI. But what is important is that not only science was moving forward, but also compute. If you look at the graph below, this is compute. You remember Moore's law, that compute doubles every 2 years? No longer relevant. Since 2012, when Jan LeCun had that dinner with Eric Schmidt and Jensen Huang, when he persuaded them that deep learning is a big thing, people started using video cards, GPUs, for computing neural nets. And ever since, the new Moore's law is that compute is doubling every 3.4 months. Andrei Karpathy from OpenAI says that in 10 years, we're going to have 6 orders of magnitude more compute. That is at least 1 million more. But at this pace, we're going to have 9 orders of magnitude more compute, or 3.5 billion times more compute at the same electricity consumption. So we're probably going to land somewhere in between. But this is one of the biggest things that is enabling this. And then all of the AI products were improving over time, and all those lines, the different tasks of AI working with language. It's handwriting recognition, it's speech recognition, image recognition, reading comprehension, language understanding. And around 2021 to 22, they all surpassed the average level of human comprehension. Why is this important? Because language is the operational system of humanity. Everything we've built is based on language. Everything we know, everything we use, money is based on language. Now AI has a universal API to any part of the human world, and we can use algorithms to augment humans and make life better in any part of the world without much effort. What it results in, it basically lowers the cost of producing 1 unit of labor of a white collar worker. So here I got an example with engineers. Like people say that 10x developers become 50x developers. Some people say no, that's like not true yet, not true. But there's already a measured 50 to 150% increase in engineer productivity using Copilot tools. And what it basically results, like any technological revolution drops the cost of something. The internet revolution has dropped the cost of bandwidth, and the cloud revolution has dropped the cost of storage and compute. And now the cost of line of code or cost of unit of whatever the knowledge worker produces is going to drop nearly to the floor. We can automate individual employees using AI agents. We can automate managers using Markov graphs and reinforcement learning. And we finally, at this point, can see a clear path to a fully autonomous enterprise. Like I'm not super optimistic about AGI or human-like AI or, like doomerish stuff. This is too complicated. And honestly, we don't have an architecture, we don't have a solution to how to make it yet, because, well, what's currently used has a lot of limitations, and people, it's still very powerful though, and it lets us think of how can we automate the business to the point where a person or 2 people team can create a global company manufacturing hardware, marketing and selling it worldwide, making software for it, and becoming a billion-dollar company. So we're introducing levels of autonomy, the way that you've probably seen in autonomous cars. There are 5 levels of autopilot, and we think there should be 5 levels, or 6 in our case, because we're currently on level 0 of automating businesses. And though mobile revolution was very big, but it was mostly for consumer use, because consumers use more mobile phones. AI revolution is the business revolution, because the biggest winners here are businesses. There's going to be $4.4 trillion of additional value per year in 2030 from AI, based on BCG report from AI. But it's not going to be like one company that is going to grab it. It's going to be a lot of very small winners. And if level 0 is a company, like it's 99% of today's companies, level 1 is a company that has formalized all business processes and has created a digital twin. So you probably heard a lot about digital twins in manufacturing, because it makes sense. Like, right, you try to put sensors and everything and digitize, and you have a digital model of your factory. But now we need digital twins of a software product company. We need a digital twin of a services company, of an advertising agency, because what happens there is that John talks to Lucy at like in the kitchen, in the office kitchen, and they make a decision of take something into production, and they don't document the way they worked with this decision. They don't create any digital trace for, even human managers to analyze it or for AI to work. But if we want to automate everything, we need to at least have a digital trace of everything. So smaller companies that are starting just now and they're like that, they have traces for everything, have a better chance of becoming autonomous enterprises faster than actual large companies with resources that already have stuff. And then basically we go to automating business processes with RPA and using autonomous agents as autonomous employees. Then we have autonomous managers for them and autonomous departments. And then finally we can go to a fully autonomous enterprise. This sounds like a little bit like sci-fi, like all of the books behind me, but it's going to become a reality next year. And I can bet on that because there are businesses that can fully become autonomous, like traffic arbitrage, drop shipping. It's like mining Bitcoins. People used to buy a Bitcoin miner and plug it into electricity and basically let it mine Bitcoins. Whenever the cost of the electricity becomes bigger than the price of a Bitcoin, you plug it out and wait. And the same would be with a business that finds products on AliExpress, buys them, generates beautiful images for them in modern kitchens, awesome descriptions, and puts them at like 4x price on Amazon. This kind of business does not need humans. So what we like to do in our firm, whenever we think about a business process, we try to apply a technique that Elon loves. It's called first principles thinking. Basically, you try to break down a larger problem into its fundamental truths. So if you need to make a car, you break it down not to like car parts, but to atoms, or ideally quarks of elements that together can form a car. And then you start thinking, how do you rearrange them the best way, in the most efficient way to get to a car? And we can do the same with business processes. When we're thinking about our firm is like, what do we need an analyst or investment managers or like principals? What do they do? Do we benefit of having more of that, or do like how do we optimize this? If we think about a business with let's say customer support, what is customer support? Why is it a separate function? Why is it under separate management? And then we start thinking, oh, maybe for our company, customer support is nothing more but loyalty and part of user experience. So if we can fully automate it, why have it separate? It was separate just because like UI is hipster designers and like fancy sunglasses, and like customer support is a manager who yells at people, and they're like very different operationally. But if it's automated, we can merge them and have like huge benefit for the business. So I won't go deep into that because I want to have some time to talk. But basically, this is our core business process that we have completely rethought of how we do investments. So we start with we're a community-based fund, so we have a lot of engineers who work at like OpenAI and other companies that have access to amazing deal flow. They send it to us. We do AI-based due diligence. We use it to help our community look at this and analyze this, and then basically everything we do is automated. And like whenever a portfolio company sends us an update, it is fed into the same system and is matched to the correct person from the community who can help them the most based on what they need. So investing in AI is basically like this pie is like upside down pyramid, and the biggest bottleneck is electricity. OpenAI is looking for numbers like 10 gigawatts now in some country to build this stuff. 10 gigawatts is a lot, and unfortunately they can only build in like NATO countries. On top of that, it's chips. There's another big bottleneck because NVIDIA is the world's leader, and in chips, the winner kind of takes it all because you have engineers and researchers who work with CUDA, and every other chip requires like some magic to be turned into CUDA, which is an NVIDIA framework, to be able to do that. There's a lot of people are talking about neuromorphic chips, but people have been doing this for like 10 years. Everybody been saying that we are like just 1 year behind NVIDIA. It's still the case. NVIDIA is the leader. They are deciding who can play the AI game. If you want to play the AI game, like with big guys, you gotta be friends with NVIDIA and have a quota. Like Arkady Volosh started a new company with people from Yandex called Nebius. They do AI clouds, and they're amazing, by the way. If you're looking for AI clouds, they're awesome. But they couldn't do anything before they got like a huge quota from NVIDIA. And then third level is Nebius, Azure, Google. These are Amazon. These are the guys who provide cloud software on top of the bare metal. And there's a lot of money to be made there, but mostly by corporations. Level number 2 is what everybody's talking about. It's OpenAI, it's Anthropic, it's Stability. It's all of these companies developing foundational models. If you're familiar with blockchain, this is like level 1 blockchain. Everybody's building their shit, and everybody's like trying to persuade developers to build using their technology. There's a big fight there, and developing GPT-4 has cost about $1 billion. GPT-5 would cost about $10 billion. And the saddest thing is that it's going to become a commodity very, very soon. I mean, like GPT 3.5 is pretty much a commodity that has been repeated by tens of different players, llamas, alpacas, mistrals, and like other like falcons of the world. Open source is very close. So if you're looking to invest in foundational model, make sure that you have something to win other than money. Because why Microsoft is doing this or Google is doing this, because 2-3 months of head start for them means a lot. Microsoft has increased sales of their cloud business from 25 to 50 something billion dollars in a year because of OpenAI. They are now charging 2x of their Microsoft Office price from enterprises who want Copilot because of OpenAI. And that's another 40 something, $50 billion business for them. So they can afford to burn $10 billion on technology, even if it's just like a 2-3 months head start, because they want to be ahead of Google, they want to be ahead of SAP, they want to be ahead of Salesforce. They have this kind of competition. I don't think anybody else can benefit that much. I mean, like Meta benefits a lot, but they don't have a cloud business. Google benefits a lot, but they don't have an enterprise business anywhere close to what Microsoft has. So I prefer investing on layer 1, which is AI apps and agents. These are basically vertical businesses that are very cheap to build. And this is what I love, because basically 2 founders with $50,000 worth of capital are capable of building a product that they can ship to like the largest regulated bank and sell it and get revenue, and then show this traction and raise money to actually scale. Because like a team of 2 good hackers, together with all of the generative AI tools and with this ecosystem of open source software and all of the environment, are able to do this. And this is truly unique. Before that, to build something like this, you would need to spend $1 million in Silicon Valley, or maybe $200,000 in Armenia. But now this is super cheap, super achievable. Companies can iterate faster. Founders can try more stuff, and there's a limitless number of possibilities. We're only approaching the first slice of this pie, where we are addressing the needs that people do. One of our portfolio companies, Zero Systems, is saving, I won't say the company name, but it's a huge Fortune 100 company, $3 billion that they were spending on a manual operation that they do for them for like $300K per year. So that's like a 1 million times economy. That is absolutely, that's 1,000 times economy. That's incredible, absolutely. And this is like super easy to do, but we are approaching the world where AI is going to be talking to, like my AI is going to be talking to your AI to do a deal. the internet's going to change. Like our portfolio company Perplexity, that has just recently raised around a 500 mil something. They are changing the way search works. If somebody would tell me that a startup with 30 people would take 10 million users monthly away from Google with no marketing in search, I would tell them to go check their pillbox. Something must have gone bad, right? But now that's not only a reality, but that's a market forming. And like when social networks happened, they kind of locked. Actually, let me stop sharing. So when social networks happened, they locked a lot of traffic in entertainment and news inside themselves, and these sectors had to change, had to evolve. They became content producers. Now the same happens in the information space and in small businesses or medium-sized businesses. For 35 years, the status quo was like, I make a website, I put some info on it, Google indexes it, and sometimes gives me traffic, which sometimes brings me customers. Now people don't have to go to your website to have an answer to your phone. I can ask Perplexity, what's the best way to get rid of, cat hair from my sofa? And it's going to tell me, okay, there are 3 options. Like you can use a silicone glove. You can buy this like nanotech fancy Chinese glove, or you can buy this brush. And so like, yeah, get one of those for me, and it's just going to do it. But not only products, but also can procure services that say, hey, my oven doesn't work. And it was would ask, oh, another instance of AI working. My oven doesn't work, and it's going to say, okay, it's send me a picture. Like, what's the model number? And then like, hey, I got an electrician for you that can come and fix it like tonight for $250. Like, are you in? I was like, yeah. And it's gonna go talk to that electrician and arrange it and make the deal. So in 2 years, we're gonna live in the world where my AI is gonna talk to electrician's AI, and that's like a new infinite number of business opportunities to build. So this is a truly exciting time. I'm super happy to be living, and I'm super happy to be like, well prepared with a very good community of 119 ML people to be able to figure out which businesses are going to make it and which not, or at least guess. Like, I don't think but I've never been so excited about a vintage. So it's currently Silicon Valley, how Silicon Valley looks at this. There are 3 schools of thoughts. The first school of thought is that we're a large fund. We're going to wait and we're going to invest in winners. When it's because nobody understands who's going to win, we're going to wait till there are clear signs. Basically, that's a great strategy if you can have access to the deals. Based on the current round that Perplexity just raised, it became ugly very soon. So the guys took, don't quote me on this, but the guys took, I think, 5 meetings and had 9 term sheets. 4 companies have sent them term sheets blindly without speaking to the founders, just because they all like figured it out. So competition is insane. So for companies that wait, for like firms that wait when it's clear, when there are clear signals that somebody's winning, it's too late. The competition is big. Silicon Valley has too much money, way too much money, way too much dry powder for that. Then the second school of thought is that we need a moat, because OpenAI is, changing the status quo all the time. They're destroying moats. Anything can be built now much more easily. We still want, a moat. And what people say by a moat, they have this like old school of thought where they were investing in SaaS businesses, and they say software complexity is going to be my moat. Number of integrations your software has, or like millions lines of code. Or something that is very, very hard to replicate. So this is partially true to we sometimes like investing in businesses that have, that need a genius to write a certain solution, or some solution is so beautiful and efficient that is just so much better than everybody else's in the market. However, we believe that moats are no longer technical. Moats are like, we're going back to business school shit. We need the power of brand. We need uneven access to distribution. We need unfair market advantages. We need economies of scale. We need this kind of shit to form a moat. And it's no longer technical because again, copilots make anything human, white collar workers do cheaper and easier to do. And then the third school of thought is everything's going to change. Like there's a quote that I like by Ilya Sigalovich, co-founder of Yandex, who unfortunately died early. But he said this, and I loved it. And this applies to the current stuff. He said, the progress is unstoppable, but nothing is going to work. And this is basically what describes the world we live in. We can't stop AI, but nobody knows how it's going to work. And like, we need to bet on founders. So the third school of thought in Silicon Valley is just like betting on good founders and letting them figure it out and like helping them. This is what we believe in. There's again a lot of competition for good founders, so it's hard to win deals. Not only we need to solve being more informed than other firms, but also we need to win them. So like whenever Ihar introduces us to a company, or whenever we introduce him to a company, we like have to pitch them real hard, make sure that they are interested in working with us, and then like putting our small check, 100K or 200K into the deal, and then supporting them. Because if something changes, if they have to pivot, and most of them will have to pivot multiple times, we need to be betting on their skill set, on their experience, on their gut feeling, their grit and dedication to figure it out. Thanks. That's everything I wanted to talk about. Let me know if you have any questions. I see there are a few questions in the chat.
Yeah, absolutely. Thanks so much for that, Nick. Like super thorough explanation. We definitely have a few questions. I think we might have the time to pick one up now, and then the rest we can send it through the type form and can make sure that you can answer them later. I have like Jan here who mentions, Nick, what do you think about Singularity Net? And in this context, Ben Goertzel's vision?
I think it's still too far away. It's very theoretically interesting. We need to remember that just 5 years ago, half of the people who currently have access to the internet and to all of the services, including ChatGPT, did not have that access. Like while we're speaking about, AI, people just literally got access to internet yesterday. So we are, if innovation is adopted, like spread, normal distribution curve, bell curve, we're living at these forefronts, and there's a huge gap. There's a good book called Crossing the Chasm. It's about this chasm between early adopters and mass adopters, and we haven't seen mass adoption of AI yet. And basically, why OpenAI is doing what they're doing, not only because Sam wants to build a large company, but because a part of their mission on the road to AGI is to increase adoption of AI tools, to make it a household thing. Everybody's using AI for their businesses. Everybody's using AI for their homes to help cross this chasm. So I think like these theoretical ideas, they're very, very far away. That's a great about a 220 model is going to be changed due to more and more introduction of AI into the VC world. I personally hate the 220 model, especially the 2% part of it, because it does not work with small funds. Every time you build, like for me or for Ihar, for every GP, whenever we want to build a business, not only invest money with good returns, whenever we want to build a business, we need a team, we need resources, we need to be building these tools, we need to be solving, being informed and having access, and we need money for that. We have one way to get this money: raise more money for the fund. But the more money we raise, the harder it is to deploy it efficiently. Andreessen and other mega funds, they have no problem of being informed or have access. The problem why they have this like subpar performance sometimes is because they invest 100 million in amazing companies and then still have 900 million in the fund to deploy. And they start picking companies based on, where they can deploy, and that becomes like super tricky to return. So there's like this triangle of like being capital efficient as a fund and investing in a lot of deals and being very helpful. And you can only choose two, because if you're very helpful to a lot of companies, you need a lot of money and you cannot fit it in 2%. So this is why I really like venture builders. They don't have this criteria. They can be building a lot of companies and being very helpful to them without having to be capital efficient. But this has to change. I mean, like, we're currently facing the same thing. We have to feed all of our like engineers and product managers that we have in a small firm of 30 million AUM that other firms don't have in the same 2%. Investing in smaller funds, I mean, like as an LP, I like smaller funds way more than large funds, because I don't know how 8VC is they're amazing people, but I don't know how they're gonna return anything from $1 billion seed fund. That is crazy. That is very, very high. They probably will, because they're amazing, but it's so much easier to return like a 60 million fund 10x. Good. Any other questions?
I think for the interest of time, I'll ask the guys to actually send them to you like through the type form, and definitely will connect with you after the session. This was super. Thank you so much, Nick. Like really love to hear about that. Definitely want to talk a little bit more about the top of the pyramid that you showed earlier, and we'll definitely come back with that with a post in the next few days. So thank you so much. And for the segue on the venture builder, we'll get back to that in a minute with Max, who's going to talk to us a little bit about that in the last presentation. Before we get there, I would like to give the floor to our third speaker of the day, and that is Marko Sutic from Rainmaker Securities, who's going to talk to us a little bit more about secondaries and everything that happens in that side of the investment landscape. So Marko, the floor is yours.
Thank you, guys. Thank you so much. It was very interesting to hear both Nick and Ihar speak. You hear me well, right?
Yes, I can hear you perfectly.
Yeah, very good. Very good. Well, I would start from, a brief introduction about myself and Rainmaker Securities, just to give you an oversight of the firm, what we're doing currently, and what is our business. So Rainmaker Securities is a registered broker-dealer firm based out of Miami, USA, FINRA and SEC registered, obviously. There are 65 registered representatives like myself. We are, based and all over the world, on all 5 continents, and on average, we do 30-40 transactions per month. I'm one of the team, one of the 63 people on the firm, and I have a personal track record of more than 120 secondary trades closed since end of 2018, which is when this became my 24/7 job. So when I speak about secondaries, I would like to, just give it a brief definition of what a secondary trade is, because, it's actually pretty simple. It's opposed to a primary round raise. There is actually a secondary market for all of the private equity stocks in the US and in all around the world, not only US. What we as brokers do, we connect interested buyers and sellers in this market and help them facilitate a trade. So we are licensed to do so. I personally hold Series 7 and Series 63 licenses, which allows me to work to facilitate trades in full capacity between US residents. And what happens on the secondary market is that basically you have a big pool of investors who are usually VC funds, family offices, and sometimes ultra high net worth individuals on the buy side. And on the sell side, you have either early investors of private equity firms, early businesses, early stage businesses, and employees who have started early, have a large pool of options that they would like to liquidate for any reason out there. And as a firm, we actually help them do so by facilitating a secondary trade. So it will be more clear when I pass to this slide. So there are several structures that we usually refer to when speaking about a secondary trade. But for the most part, the least risky Well, 90% of everything we do is basically a direct secondary transaction where I would find a buyer, I would find a seller, introduce them, help them fill out a share transfer notice, which is a very basic document that gives you just an understanding of the trade. It gives a very 2-page document saying name of the buyer, name of the seller, the security we're trading in, the price, the size. And we would just file it to the sign, of course, to make this trade a binding commitment, send it over to the company. And this would trigger a so-called ROFR procedure. Well, the company would need to facilitate the trade. They would need to approve it. And usually it takes about 30 days. Within 30 days, they would get back to us usually with the best case scenario, with the waiver of ROFR. The buyer and seller would execute a share transfer agreement, and further the buyer would fund the transaction, and the seller just needs to get back to the company and tell them that he's received the funds, and the company just updates the ledger. And as an end result of a secondary trade, the investor would be receiving a share certificate. Usually these things are everything is done via Carta. You probably have heard about this tool. It's very standard. It's either Carta or ShareWorks by Morgan Stanley. So here would like to focus a little bit more on the names that we traded last year, and probably this would give you a good understanding where the secondary market is. Well, first of all, just all the names that I brought here are these are late stage names, so-called pre-IPO names, the names with high valuations. Our firm basically specializes in names in unicorns and companies that have 1 billion plus valuation. And as both of speakers and specifically Ihar mentioned, I totally agree. So 2021 was a year of high peak valuations. Everything was trading at a great price, enormous price. I would say somewhat unreasonable price. But right now, the situation has changed drastically over 2022 and 2023. So every single name that you see on this slide right here is trading at a steep discount to last round. Or, for example, with Rubrik, it doesn't trade with the discount to last round. It trades with a huge discount to where it was, traded in the secondary market in 2021. Now, for the exception of SpaceX, which is somewhat a unique company, and SpaceX is trading, SpaceX is basically seeing just the growth in the valuation. It's trading, the valuation has been going up. It's a very consistent, very, I would say, well-managed company, and traditionally it has seen huge interest from investors all around the world. Sadly, investors with Russian background and Chinese background are not allowed for the last 3 years, but or more, I would say 3 years. But as a company, SpaceX was a great performer, and we always have both buyers and sellers in SpaceX. It's one of the company that's been one of our, how to put it well, milk cows, because we always have demand for SpaceX. And names here that I brought up here. A number of other potentially interesting opportunities right now in the secondary market. I would probably name, and these are not AI names because AI names were absolutely hot this year. But I would say that if I was a private equity investor interested in names that, later growth companies, later stage names, I would be definitely having a look right now into Klarna. Klarna was trading at $1,600 in 2021. At the end of 2022, the company had a major down round. And right now, the price is around $250, $260 per share. So you can imagine it's like 6x or 7x down round compared to 2021. I think it's a great opportunity if we take into account my personal thesis that, the future will bring more certainty in terms of geopolitics, in terms of, Fed lowering interest rates. So if the market goes in the direction where I personally anticipate it would go, Klarna could be a great investment right now. This is by no means an investment advice. I'm not entitled to that. But if I was an investor, I would definitely have a look at Klarna. Some other names are Gupshup, very interesting. Gupshup, I think, had a bottom this year of it was trading at $13 per share, which is a discount to the last round at $19. And now I see interest in it, and investors are very much looking into the Gupshop, and it's trading at par to round. Same as Deal and Rippling. These were very popular in 2023 amongst investors, and they have seen the secondary price at least has seen a immense rise over the last year. Now, specifically, since I mean, it makes sense to give you a sort of a brief insight into what I see when speaking about late stage AI names. There are currently 5 large companies, so besides obviously OpenAI, that are creating the market for secondary trade in the US in general. And I would say that there has been a huge hype this year. So I personally had in one certain moment of time, maybe October this year, I could have brought like 500 million in terms of buy side interest in, for example, for OpenAI. It was a hot name, and it was also a newsmaker for us. And sadly, most of the investors backed out of recent, anticipated tender round. It was supposed to take place in December, which didn't. Yet we think that the company, well, at least from what I hear from my peers, from my colleagues in the market, the company will have their tender, and it will take place in January, specifically 5th of January is what I'm hearing. And although the interest from investors has decreased significantly, the company is still, looking into $86 billion valuation, which is a significant upside compared to their last round. I think it was $29 billion. But with that said, there are 4 other very interesting names. I think that my fellow speakers know well about them. So, and why I'm bringing them up, they're just, stars in the secondary market right now. The second most interesting, the most discussed, the most traded name is Anthropic. And then I would say a company called Cohere, Scale AI, and Hugging Face. So these 5 names right now, they are making at least from my perspective, they're making the secondary AI market, and there's a lot of interest. So these were the companies that had seen immense rise in valuation and prices in the secondary. So yeah, that's what I see at the moment. To recap, so everything you see on this slide has seen basically a decrease in valuation, for the exception of SpaceX, which is constantly little by little is going step by step is going to higher valuations. The company is valued higher, and the companies that are not on this slide, so the five ones that I brought that I raised, these companies are extremely popular. And if I were an investor in late stage AI names, I would definitely have a look at Anthropic, Cohere, and Scale AI. So a couple of more slides. So in general, this market exists, in my opinion, because companies have seen, they prefer not to go public. Companies, at least over the last 4 or 5 years, I think, have preferred to fund themselves by actually, not going public and raising funds in primary rounds. And sometimes the investors and the shareholders are raising liquidity, participating in this secondary market of ours. So the median time from founding to IPO has increased significantly for this very reason. And right now, I think that we have a good perspective. There has been an increase in number of unicorns. You can see the numbers speak for themselves. There are more than 1,200 unicorns right now, beginning as of July 2023, and I think that this number will grow. And when a company becomes a unicorn, it hits our radar. And when a company becomes a unicorn, the stocks become more liquid compared to their early rounds, obviously, because there is a market for stocks of privately owned companies, which with valuations higher than $1 billion. This is a short disclaimer, which I have to put because of my regulatory requirements. But probably one interesting thing I would love to announce is that I am structuring my own private equity fund, which will invest specifically into growth companies. I think so. The thesis is that right now is a good moment. I think that Ihar mentioned that. So right now, I think it's a good moment to enter the market for names like Klarna and Rubrik and many others. So right now, as of Monday, Mauritius regulator has approved my fund, and it will be a regulated fund, closed-end fund company with cells. By February, I will be open to partnering up with everyone as the fund manager as well, besides being a broker. So yeah, that's pretty much everything I wanted to bring up today. Thank you, everyone. And thank you for this opportunity. It was a pleasure talking to you. Would you like to ask some questions?
Thanks, Marko. It was great to have you. Definitely, if there's some questions, guys, put them in the chat or feel free to raise your hand and then ask them directly.
Yeah, I can't see level 1.
I don't see one yet, but I do have one for you. So you mentioned a couple of companies in the portfolio and some that you've done secondaries with, right? Like, as someone who hasn't invested in secondaries yet, that might be listening to us at the moment and is thinking of like getting exposure to this, like, how do you start differentiating a company that currently, from the market dynamics of 18 months ago, is, you know, decreased slightly in valuation, or even not slightly, but like 50%, and is currently at a great deal compared to the future market potential, versus a company that might have lost 90% of its perceived value in 2021, that was largely overinflated, and the balloons here, and that essentially might never recover to you know, its highs of 2021. Like, how do you differentiate that? How do you get exposure to a variety of companies to maybe avoid some of those investments?
Well, there's actually plenty of data, and we operate with companies that have reached a certain level of development. Like, it is the thesis is, at least. For example, let's discuss Klarna, because I brought it up. The company is creating news. It's a big company. It's a big neobank, and the down round has taken place, and yet you can see first of all, there's more publicly available data for Klarna than compared to, you know, earlier stage companies. Second, well, the company itself has declared a down round, and third, we see interest in major market players like large funds who are investing in these kind of companies, and they're purchasing Klarna a lot. So if probably this is some kind of an insider view, but as a person who is, you know, in some way making the market, I see a huge interest in Klarna. For example, it's the same interest that I see in Rubrik right now, same interest that I see in Deal and Rippling, and for example in Scale AI as well. And I think when you see that much interest from investors from large funds, that something is definitely boiling and cooking there, and this might be a potentially interesting company to enter the market in. My personal opinion is that we hit right now the bottom in 2020, end of 2023. I think that things will get better. I'm just optimistic. But how would you? And have I answered your question, by the way? Is that what you're asking, or did I hit? Yeah.
Yeah, I guess to some extent you have. I think partially is more, I see that there is sometimes like interest from investors who don't really have a lot of insights into how the company functions, aside from the publicly available data and the books, but in terms of bigger dynamics of a lot of executives leaving, a lot of internal discussions that isn't ever going to be made public until you know, things are real bad, and companies that have lost like significant amount of valuation, significant amount of customers, not just that the valuation is down because the market is down, but because their actual revenues and the inner workings of the company might not be great. That is not easy to figure out which ones will easily rebound and are actually a great deal versus the ones that are on a bad slope and might never ever come back up, right?
That is absolutely true. Yes, I agree. Well, in general, the issue with private equity is that the market is not transparent, and access to information is actually pretty hard to get. Probably one of the perks with working with us as a regulated broker is that we do have information from the market, from, you know, participants, and usually our investors in our network are open to sharing data. Of course, we have access to PitchBook, the obvious kind of thing, but we also have information that comes from the market, and we can give valuable insight into what is going on in companies that we think that are, for example, for example, Klarna, are interesting. Yes, you're right. Likely a lot of companies will never recover, and we see that. I don't know what was the possible delay. The latest example of a company failed. I think the one that was renting out offices was a huge privately owned company and failed. I think. I just don't remember the name. There is well, of course, there's a lot of risk associated with these kind of investments. I cannot give you a clear, a clear, a golden rule solution how to pick the companies, but everything, I can only share what I see in the market. So objectively speaking, there is no like clear recommendation how to differ one from another, besides always being in the market and seeing what is cooking and boiling. When you see an investor like Andreessen Horowitz or whatever, or Lightspeed Ventures investing into company and deploying a lot of capital, even on this stage, there's something to it, right? And we have insight to that.
Brilliant.
Thank
you so much,
Sebastian. Thank you so much.
No, that's super, super helpful. Thank you for that. And if people have more questions with regards to that or want to know more about some of the insights that you have or how to get started, then obviously feel free to reach out to Marko or to let me and Dimitri know, and we'll make sure to make that introduction so that you guys can chat. And congratulations on the new fund that will launch early next year. We're looking forward to following that as well.
Thank you so much.
Brilliant. So now I would like to move on to the last speaker of today, and a topic that we've briefly touched upon with Nick earlier on some of the newer models that are taking place in the investment landscapes at the moment and the rise of venture studio. So last but not least, I'd like to welcome to the stage Max Pog, founder of Heels, who's going to talk to us a little bit about this rise of venture studios and why this model has recently become very exciting. So Max, the floor is yours.
Hello. Yeah, I can share my presentation. First of all, if Nick was here, I would say thank you for the recommendation of Perplexity AI. I'm using this tool, and it helped me to find more information about venture studios while doing the research. Yeah, so the rise of venture studios. First caution, I have only 15 minutes, and it's not possible to delve into many details. And this venture studio model is very difficult with a lot of structures. The data is limited, and studios have many problems. If you want to find the problems, you have to go to this to read my research, because I put 1,000 hours to prepare it. Yeah, but today is the most interesting insights from this research and from opportunity of investments into venture studios. Yeah, what a startup studio is. It's a company which creates new companies and has from 20 to 40% equity in each company. So I can show you this structure. When here you have studio team of 10 to 30 people, sometimes 5 people, usually 10, 15, sometimes more than 30. Here you have entrepreneurs going to a venture studio with or without ideas. And studio also invests money. So not only the team works on the several startups a year through several stages from ideation to growth, but also studios usually invest money. A bit about myself. My name is Max Pog. I'm an entrepreneur, created 3 companies. One I sold 13 years ago. But if you will wake me up during the night and ask what is my name, probably in 50% of cases I say venture studios. My name is Venture Studio because for the last 1 year I've done a lot of projects around venture studios. So first, it was 7 months research on venture studios, which went viral on LinkedIn. And I got inundated with many opportunities and messages and positive comments about this paper. Second, in November, we held the two conferences, the two biggest conferences for venture studios. Each conference had more than 1,000 registrations and about 600, 700 people, unique visitors at our online conference interested in venture studios. Then I'm doing venture studio podcast, so recorded probably maybe 25 or something episodes. And just today, it is the day when I'm recording two podcast episodes, one before this presentation, one after. Then this month we launched a community for venture studios called Venture Studio Family, and also Dmitry Samolovsky invited me to co-lead an investment syndicate for venture studios and their spin-outs or their startups created in studios. So this is why I'm talking today about venture studios. If you will look at different kinds of VC players, you will find that there are VCs and private equity investing in companies, and usually they don't manage those companies. So they cannot say that we created a company. They say we invested in a company. Then there are incubators and accelerators who can say we incubated the company or accelerated, let's say, 50 companies. And here you have startup studios who actually can say we created those companies, we co-founded those companies, because they are full-time teams working on several startups a year, sometimes more, but usually studios who are operating less than 5 years, so they're doing between 3 and 5 startups a year. And their team, let's say 15 people, they split between those 4 startups. So like several full-time specialists are working on this startup. I've done research, so there is a venture studio index database consisting of 400 studios and 1,800 startups created in studios. And I counted their time from foundation to different financing rounds and also to exits, and compared it to the most close benchmarks which were available, and found that studios create startups which reach financing rounds 41 to 51% faster, and exit 31 to 33% faster. So like factory is more efficient than a manual labor when you are an independent startup, raising funding and then doing all from scratch. There is statistics by GSSN in 2020 where they surveyed 258 startups created in studios, and found that like 60%. So they served not startups, they served studios created those startups, and they found that out of those startups, 60% reached Series A funding, which is, I think, I don't know the benchmark, but probably maybe twice more than in the wild market. There is also not many research on the investment efficiency, and the data we have, it's only two papers. One paper is the same GSSN, Disrupting the Venture Studio Landscape, which shows that 53% of IRR in comparison with 21% by usual non-studio startups. And also just fresh research, maybe published 2 weeks ago, something from World Fund. They collected information about investment efficiency of venture studios, and they found that top quartile venture studios generate 60% IRR in comparison with 30% IRR generated by VC funds. And also there is the bottom part of this research showing like comparison of TVPIs of different accelerators, and you can maybe not so accurate, but at least have some sort of comparison with studios, with startups created in studios. So showing that startups created in studios showed similar way in terms of TVPI for investors as Y Combinator startups. Why is it so? And I want you to think for, I don't know, 5 seconds. What is the main reason? So do you have some idea of the main reason why startups created in studios show better performance in comparison with independent startups? So yeah, I would like to find this answer in the chat if you have time, but at least think about this. And now I want to show you some how to say, idea to make it memorable why these startups created in studios are a bit more successful than in wild. So $10,000 challenge, which is I have a special skill, and my challenge is for you. If you don't have the skill in your previous experience, and you can beat me up in the skill in 24 hours, so you can train in 24 hours. If you can do this, I'll pay you $10,000. So what is the skill? People who visited my conferences, they know it. But yeah, I want to show you. It is not just to be to show something here, but actually to demonstrate that why I'm so confident that you cannot beat me up in 24 hours, because I know that I trained this skill maybe 50 hours if I will sum all the time. So I did it 50 hours, and I know that no one person in the world in 24 hours cannot do this without previous experience. Yeah, so the same with startups. And it is showing by a lot of statistics that VCs generate more returns when backing serial founders. And also like that founders with previous entrepreneurial experience are more likely to create a successful company and have exit. So here is statistics from 2014, where you can check that like the first time founder, the first line here, had 5% exit rate, and by fourth or fifth company here, it is twice of that. So and there are also, so actually everything I'm showing in this presentation, you can find the sources in this my research. So VCs generate high returns when backing serial founders, and many VCs blindly invest in second-time founders. And I know that some are focusing only on second-time founders. And studios' accumulated expertise gives founders an unfair advantage, because they created not one company, not two companies, not three companies. Maybe they created already 10 companies, maybe 15. Some studios created more than 30 companies. And so, yeah, and if we had a statistic here for like how many, what is the exit rate when you created 10 companies, for example. I think more experience, better results. So this is the reason. And here I'm showing another one example, another research, which found that founders with 3 years of niche experience or expertise, they are 2.2 times more likely to create 0.1% high growth startup in the same industries than those who didn't have this at least 3 years of experience. This is the main reason why studios produce more viable startups, and why their accumulated expertise is better than just startups in the wild. Here I have a case for you. And the question. A 4-year-old studio building B2B SaaS for industries, for manufacturing, for factories. The studio team visited factories 860 times in 4 years. They launched 15 companies, 8 got Series A funding. in 4 years. And in 9 to 12 months, they generate $500,000 ARR, and it is like the standard trajectory of each of their companies. And so the question is like, do you know how many founders want to join this this studio? The answer is here, 8,000 per year. So they get 8,000 applications per year. The studio invests 500K for each startup, takes 25% of equity. And from this 8,000, they're choosing first like 10 entrepreneurs, launching 4 or 5 companies, one they kill, so they're ending up with 4 companies a year. And 60% of their founders, of their co-founders of their startups had previous exits. So it doesn't mean that only first-time founders joining studios were ready to give up 25% of equity. So founders with previous exits also find this very valuable. Why? Because no one VC firm, early stage VC firm, can deliver the same value, the same expertise in this startups created in the studio. So no one VC firm can say we visited factories 860 times. This is why we help our startups to generate revenue at least 2 or 3 times faster than startups in the wild doing the same. And so this is a big opportunity for venture studios to focus on second-time founders and being able to attract them to build startups, because founders understand with this studio, with such level of expertise, we have at least twice probability of success if we are doing it without the studio. And also we have reputation, we have investments, we having fast attraction. So this is why founders can choose a venture studio. This is one example. It is not the studio from the previous slide, but it is another example of also a great studio. E-founders, now the Hexa ecosystem consisting of 3 startup studios. And recently, just maybe 1 week ago, they raised 22 million euro to scale their studio. So they created 3 unicorns out of 35 companies. Now they have 40 companies. So, and they say that it made us realize that by starting a company with a Hexa startup studio, you increase your chances of building a unicorn by 1,000 times, no less. And you can see that like they're doing B2B SaaS. It is growing to 235 million a year of their portfolio companies. Yes, this is an example. And also, I also like the book Crossing the Chasm. But you can see that even if studios grow very fast now, so still I think that this trend is very nascent or like new, and more studios will come, and yeah. So it's great time to join this venture studio ecosystem. And here are some investors who invested in well-known studios like Atomic, PSL. Actually, Pioneer Square Labs is our member for our community venture studio family. Just yesterday we talked. Expa, so well-known people invested. And if you want to get to know more about venture studios, you have to read this report. And you can contact us. I don't know, is there a QR code, Dmitry? Do we promote some QR code about Uniborn today? But I think that people who are interested in joining can find all the information. Okay, yeah.
Yeah, absolutely.
So for next 30 seconds, you can scan this QR code, and yeah, I'll stop my presentation.
Brilliant. Thank you so much for sharing, Max. Indeed, you can scan the QR code on Max's screen there, or obviously you can connect still through the QR code of Uniborn here next to me, and we can put you in touch with Max. That's no problem at all. Lovely to hear a little bit more about this model and kind of what it can offer to external investors. I think it is somewhat been around for a while, but has gained popularity very recently with a lot of new players on the market, as you've just shown. And very excited to see what can actually happen in the space in the next months and years, with more and more experienced founders of those studios creating success stories that actually shows that the return is impressive and potentially more lucrative even than the traditional VC model in some ways. I would like to ask you one quick question, as don't see more in the chat at the moment, but what was one of the most surprising facts or findings that you got to learn while doing the research? Something that you really didn't anticipate that kind of came through the data of you researching the studios?
Yeah, the biggest problem of studios is the quality of founders. So the quality of founders a studio attracts correlates with the success of the studio and its performance. So, and I think it is the most important thing. And many studios, many successful studios, make it a North Star. So, question like, can we? What should we do to attract the best founders possible? And it is the case of those two studios I mentioned earlier, and like many studios underestimate this question. And so I think that there are two answers to this. First is two solutions. First is the quality of a founding team. So if founding team has some entrepreneurs with previous great track records, ideally with previous exits, so it's more likely to attract great founders, because like if the studio team is very charismatic and they had under the belt exits, so it's much more likely that also a great founder will join the studio. So this is the first founding team. The second is if you're choosing a niche approach, so it's much more likely to show real additional value to each startup, because by creating 10 startup in agriculture, it's much more easier and it's much more efficient than creating the first or third startup in agriculture. So, and if you are choosing a specific niche, you can collect base of your partners, customers, and each new startup can reuse it. It is the case of the venture studio OSS Ventures I showed earlier. So when they visited factories, so actually it's much easier to them to sell this. So the second is I believe that without tens of millions in funds, it's very beneficial to be very niche focused and create the best possible team of advisors, experts in this field, and then attract founders in this field.
Great. Thank you so much for that. I guess last quick question that I have for today's session. Ruslan is asking here, Max, what do you think? Incubators and accelerators are becoming part of history, or do they still have their niche and some advantages compared to venture studios?
I don't know the market of accelerators and incubators. I know some, and I interviewed some for my podcast, and I know that some are successful, but still I cannot compare like what is their place now. Yeah,
maybe that will take another 1,000 hours of you digging
I think it might
into
be
the model.
viable model. So I believe it might be a great viable model.
Okay, fantastic. Well, thank you so much for your time and for the insights. I guess people have had the time to check your QR code. Otherwise, you can still scan this one here. I can make introduction to any of the speakers that have been sharing their insights with us today. Otherwise, you can approach Mitri and myself on LinkedIn. We'll be more than happy to make intros and connect. I think it's been a super interesting session with very different expertise and insights on different parts of the investment landscape. I think a very attractive moment for investors to get into the market, considering the valuation and the market decline that has happened over the last 18 months, and for people who have been able to plan and keep capital a lot of very interesting deals at very attractive valuations currently. So very happy to hear that from all of our speakers. Thank you for everybody who tuned in and who joined for this first private banking summit that we've had, and very excited to have future sessions in the coming weeks and months. Thank you, Max. Thank you to all of our speakers, and I'm looking forward to see you guys in the next one. Have a wonderful evening.